Is I'm going to start sharing. Let me know if you're able to see this, um, especially when I go into the full screen mode. Yeah, so I think as Kiran said, the US has been one of the biggest market, and we're going to talk, right from the starting point of how we see from a global perspective. I try to zoom out a little bit on what's happening in the US market. We can definitely double click on recent events and also our philosophy of how at Proflex we have been investing into US markets. And not just US markets, I would say we talk about the global trends. Like US is driving the technology, as we all know. US is the place where most of the people come to, for financial products, for technology products, and so on. So that is going to be the intent. So feel free to us, maybe ask questions or anything in the chat so that we can adjust based on the audience. But let me get started. Um, so I think I would always start like, I always love the macro picture. So I'm going to do a little bit of a discussion around that. So basic idea here is what is US and especially US dollars, because I think when global investors look at US, they are not just investing in US, they are investing in a currency. And because as we all know, US dollar has been the primary investment source, even for countries or any kind of corporate allocation and so on, beyond the investors, individual investors. And so we always start with like, what is the US dollar perspective before we even jump into US markets. And when you look at US dollar, there is a lot of story around, de-dollarization and all that. So we look at the data. What is happening in the USD allocation across, these are the country reserve, these are the sovereign nation USD reserves. And we can clearly see that even though some people would highlight shorter term trends, so this is the last 24 years or 25 years, you can see that dollar has been, this is the blue is in the dollar, it's approximately 50% allocation. And the only asset class which is competing and taking away some share is gold, which is at the top here, which is now there are reasons for it, of course, because we call it as a peak globalization behind us. We are looking at more and more conservative thinking. That can be one reason. But also, I think if you see, there is no other currency which is ever catching up. In fact, as dollar is going down, euro and yen and all other currencies are going down in allocation. So in other words, what we are saying is USD is still the prime candidate for all the reserve allocations, except that there is a intent being shown. And I have reasons for it. I don't want to go into it into too much of geopolitics, but as you can understand, since the Russian conflict, the Crimea 2014, and recently now the Cold War with China, these are prime reason why gold is getting higher allocation. Now, beyond just the reserve assets, now look at the industries and where the business is done. Again, it's a US dollar dominates there. I think I don't have to go into every detail, but we talk about share of global GDP, share of global trade, and ultimately the global GDP anchored in the currency is USD. One thing which I would like to also highlight is most of the international contracts which are done even in non-US, when there is no party involved in US, they are done in USD because of the same reason. So these are some of the reasons why US dollar assets are very critical for everybody in globally. And this, what has happened is because of that, the US capital markets have grown very fast. Not just because people want to invest in USD. We will talk a little bit more about why US markets are growing so fast. But I just wanted to give a perspective of that US stock market itself in capitalization has grown six-fold in last 16 years. It used to be of the order of 10 trillion not very long back, and we are at 60 trillion plus right now. Now, in terms of inflows, again, US dollar is attracting continuous inflows, as you can see in last 25 years. And the FDI is continuously increasing. There is no slowdown. You will keep hearing the story, and I keep getting these questions from not only from our investors and so on, that there is always a narrative thrown around that people are pulling out. So if you can see, there have been some blips here and there. Why we are looking at a longer term trends is this tells us that it's almost exponential if you look at it. And again, we will dig a little deeper into why that is happening. But we always talk to investors that you should zoom out because there's a lot of noise always. Like, for example, right now we are going through this whole trade war discussion, de-dollarization discussion. But again, these things have happened before. And we have seen some blips in the investing in US, but that doesn't change the long-term trends. In terms of foreign ownership of US equity, now we talked about how the corporate equity market of the capital market of US has grown from 10 trillion to 60 trillion. So this is a great number because this is the data which we have taken from Federal Reserve, that it is the ownership of US equity in terms of percentage. Now, imagine that we have gone 6 times higher in the size of the capital market, and the ownership of US corporate equity is still growing. That means in terms of dollars, we are going exponential on this side also. Not only there is a more and more money flowing into US equity, and this is again, and this is why I always look at 100-year charts, because once you zoom in, you can get lost in the noise of what is happening in last 6 months or last 1 year when people look at inflows or outflows. Now, what is the reason? There are two reasons. One is that US is the only place you can invest. This is a kind of a situation where people are investing because there is no other place. Look at the size of the market. So this is we have taken from Visual Capitalist, which is a great chart. It shows that market size of US stock market is, if you combine the two exchanges, the Nasdaq and New York Stock Exchange, that is equal to all other regions combined. That is why I think if you look at just the addressable market, like if you are an investor and if you are looking to invest, what it tells you is if you take the worldwide equity, not just your own country's equity, but worldwide equity, 50% of the options in terms of the market cap is sitting in US. So that is the intent. And there was this great statistic I remember. Somebody was telling that US is like 4% of world's population. It is 24% of the world's GDP and 42% of the whole market. So this is how I think everybody looks at, like there is hardly any option in terms of market size. Let's take a little bit of a step into debt market also. Now, as we all know, and I think as we go into professional investing, nobody wants to, like people use leverage, people use margin, and you are always looking to park your main capital in some kind of a debt product, some kind of a safe haven. Like for example, when we do investing into markets, we want the margin money, like for when you're using margin to trade, you want to have some kind of a marginable debt asset, which is interest bearing. So you need a solid debt market, which is risk-free in investing, even when you're investing into that. So now look at, this is why I think one of the big part of it is US also offers one of the safest, biggest treasury market. And that provides us safe haven investing. And if you are in the market, you also know that worldwide, US treasury returns are considered risk-free trade, like where you park your money. One thing is the risk-free because of the US dollar being considered the reserve currency. The second is, as we always say, US always pays. The reason being, you being a reserve currency, US can always print money. And there is a lot of debate, and we can discuss that if people have interest on. I see that on Twitter. I see a lot of discussion about US debt being unsustainable. And I still remember those days when we had heard the term $1 trillion first time, and people had a very similar discussion. Oh, US debt is unsustainable because we are hitting $1 trillion. Today we are sitting at, 32, 33 trillion, 36 trillion, and so on. And the numbers keep getting bigger because US has a power because of the reserve currency and because of the ability to print money. And most importantly, if you are looking at 60 trillion market cap in the capital market, in my view, you need a bigger debt market to even sustain that kind of a equity market or rest of the risk markets. Because as I said, whenever you're investing into those markets, you're usually keeping this into some kind of a debt product, your capital in. Now, let's look at again, I go back to why US can do what, can issue more and more debt. One more thing is US debt market is the safest market in the sense it has the best bid-ask spreads. It has the least amount of volatility. And people recently have started discussing about Euro as an alternative. If you look at the Euro bid-ask spreads and US Treasury bid-ask spreads, you can clearly see that nobody wants at an institutional level, if you are trading, you don't want to see these kind of numbers which are so high. Similarly, the volatility of euro zone is pretty high. The Japanese debt, as we all know, has been one of the biggest attraction. It is another big market. And what was happening there is, first of all, the interest rates are very low, so they were never competitive. Now the yields are going up. But when the yields are going up, it's also considered right now people are concerned about yields going up much farther because they are not addressing it yet. So there's a lot of, again, I don't want to discuss the details of it, but basic idea here is every every other alternative to USD has some kind of issues going on, whether there's a volatility, whether there is a not enough depth in the market when you look at the bid-ask spreads. It is not as liquid as US debt markets. So now coming back to the capital markets, which is where I think most of us spend time on, and which is where the most of the growth is. So the other factor is the technology companies. And again, I think this is a very well-known fact that US is home to the so-called Magnificent Seven, and even the top 20 global companies, if you see, and you go down the list, you will see there is a Saudi Aramco, which is like, the oil company. You will see TSMC, and there is hardly any, and then there is a Tencent from China. So you see only three companies which are outside US. Now, this is again, giving us the same indication that ultimately where most of the value is being created, whether it is and mostly tech, I would say, because that's where most of the growth has been. If you see we are moving away from the world where even in old days, when I started investing, US used to have the oil companies and these healthcare companies to be on the top. And the world has changed because of the amount of exponential value creation with companies like Apple, NVDA, Microsoft, Google, Amazon. They have totally taken over the capital markets. And this is where I think me and like our team being in Silicon Valley here, we see it every day. We see how it is taking, we are now, when we talk about AI investments, when we talk about other factors, this is going to be continue to do so because of the lead they have taken, like in terms of when you look at the technology being used we are moving into a digital world. We are moving into the age where everything is done on computers. US has taken lead on that. So as we always say, semiconductor and this cloud, all these things have become the new oil. Earlier, we used to say whoever controls oil, they are going to be dominate the world. It's a separate fact that now, since the discovery of shale oil, US has also secured that. So that has also given US confidence because now they also are energy independent. But I would say that the prime reason for dominance of US right now is because of technology. And we are going to jump into now where the world is heading in terms of why this trade war is anyway starting. This is one of the other reasons, because the biggest threat is China for US. But anyway, keeping our topic to, again, the leadership of US in investments, and where I think being in the technology space, this is where I think we spend a lot of time on. And you can see here that who has invested most in artificial intelligence or kind of developing technologies around it. Again, US is leading, and the closest, if you see somebody coming behind, is China. Again, US and China is going to be the theme of the rest of the presentation. We are going to continuously look at what is really evolving, what's the future of overall bipolar world. But let's first look at how this is evolving now. So when we talk about dominance in AI, we are also looking at the number of AI models and which are the where we are seeing those. And this also leads into, okay, is it only AI, but or across the market? So even if you look at the total R&D spending across different domains, this is the World Development Indicators, which talk about US and Canada. Means again, Canada is mostly US investments. This is shown as the outpacing almost every other region, whether it's Europe, whether it's China, and other developing countries. So this is where I think it boils down to, when we talk about growth investing, the growth is into futuristic technologies. The highest growth we have seen is always in the future technologies rather than, I think, when we look at other countries, which are where the investment options probably like, when we do our India fund and we're investing into India from US, we always say, where is that growth? Like, you're always looking at ROI, mostly looking at, how capital efficiency and so on. In US, investing is very different because people talk about multiples. And this is where Silicon Valley has excelled at, where what we talk about is there is and this is what I think I've been involved in the VC investing and so on. And when you look at the multiples people talk about, the growth capital availability is also highest in US. So this is, we're talking about at a macro level, how US is investing. But even if you look at the capital availability for research and development, where you can launch an idea and get a pretty significant backing to it, that is where what differentiate US from rest of the countries. So this continues into not only tech. When we talked about, we also have US leading in biotech and pharma, which is one of the biggest growing vector. Now that AI is also influencing it, we believe this will be a very big growth factor. So if you look at the fastest growing biotech and pharma companies, this is the 2023 data. These all of them have been in US, and that is another factor which we need to understand, is that not only these companies are headquartered here, why are they here? The main reason being, again, the capital availability and where most of the markets are pushing the money. Another factor which we are looking at very carefully within Proflex is how world is going to change. Like AI, of course, we have seen the LLMs, but AI's biggest influence will be in real world. We have two of the robotaxi leaders, Waymo and Tesla. Both are based in US. And the progress we have seen in some of these totally cutting edge technologies, like Waymo is already, like, you can come to San Francisco and you can ride in self-driving taxi. Like, everybody is using it like it is Uber, where there is no driver and so on. And they are already giving, like, 200,000 plus paid trips weekly. Tesla is launching in 5 cities in June. And I personally drive Tesla, where I don't never touch my steering wheel or accelerator or brakes. I go from point to point. So if FSD is already operational, they just are waiting for regulatory clarity. What I'm trying to highlight here is, this is where things are, where people are doing beta testing in other countries. Like China is still doing very limited routes, like where you can only do on certain streets and so on. In US, we are already seeing these futuristic products are in production. They are running at scale. So I think this is just to go back. I just want to summarize here before we move on to the section of how world is evolving around us, and maybe even take a couple of questions, and you can put it in the chat, and we can then jump into a little bit of discussion around trade war. But I think overall, what I'm trying to establish here is two factors. One is, when you are looking to allocate capital in USD, US is the place, because when you're going international, you have to invest in USD anyway, and because of the being status of reserve currencies, US is the biggest market. And it's for good reasons, because of the technology excellence. We call it US exceptionalism, where US is driving most of the technologies which matter in the future. And that's where the growth comes. That's where we see those 100x, 200x returns. When we see we see capital being deployed in AI, when we see all these tech companies putting billions and billions of dollars into AI or robotaxis, robotics, pharma companies putting in research into totally new treatments, and so on. So that is what is driving the markets, because when you put in the capital into US, you are also seeing the most cutting edge growth companies coming out of it, and which give you kind of exponential returns. So now, if there are no questions in the chat, so let's move on. Let's look at what is relevant. So I think I'm sure a lot of people have the trade war in their mind. So this is a great chart which Financial Times posted, and this was a great comparison of why this is happening. And it's not a new thing, by the way. So if people think that Trump came and changed the world, yes, definitely he created headlines, and he has shook the markets, the capital markets. But let's also look at, we always talk about geopolitics. It's a longer term trends. So this is a chart comparing US as being the supplier versus China being the supplier of the world. Now you see the red is slowly taking over from the Eastern world all the way into, like, they have taken, China has taken over not only the whole Asia and Europe, but also Africa and South America. And US is scared of, and actually for good reasons. US is basically saying here that we are losing this battle with China, which actually China created by using US, becoming US's brand's factory. Most of the IP, which we talked about why US market cap is so huge and why do we have huge companies. Of course, we talked about IT companies, but even if you look at most of the products, like if you talk about luxury products or brands like iPhones and so on, and bags and whatnot, all of that, it was a US IP which China produced, and they started taking over rest of the world. So this is the geopolitical direction where US is seeing they're losing their hegemony on the world. So this is the article which I had written, I think, even before this became a US-China thing. We talk a lot at a macro level about the geopolitics impacting economies. And when this whole tariffs were announced, I remember sending to our subscribers also our article about, like, why this is a US-China war. Don't worry about it. Everybody else will be negotiated down, and US will mostly is trying to create a trade war with China. And as it happened on April 9th, exactly that happened. And Trump reversed tariff on everybody else other than China, because ultimately the target was China. So what are the real problems? Why this means the US is, taking this approach, because it is a very simple thing. We have been living, from all of us, if have seen mostly a unipolar world where US has been dominating. And as we just saw in the previous slide, China is slowly taking over the world just by becoming the factory of the world. And as we know, this trade and, all these excess surpluses which China is accumulating, they where do they go? Like when you're China, you're selling, and you're selling in every country, and especially in US. You are basically accumulating a lot of local currency of that country, and you end up investing in that country, and you start owning more and more real estate, more and more companies, more and more, like, you almost are becoming the owner of that country, as your corporates and so on. This is what I think US has been watching, like, how China is taking over Europe and Africa and all the other places, and almost now reaching a stage where US is threatened that they will start taking over US. So this is what I think is the factor: the China dominance growing and the diminishing US hegemony. These are the main reasons of this trade war, and also the past mistakes of using military spending to maintain the dominance. So US has always used military dominance to keep their unipolar world, but China has used the trade to their advantage. So what is US plan of action? And this will help us identify where we are heading. So first of all, US is trying, what Trump did by creating this initial tariff on everybody, he try to identify who are the allies and who are going to go with China. So as you can see, like, very obvious. And again, when I wrote this article, when this first tariffs came out, and that is exactly what we are seeing right now. Like, there are obvious allies, which are Japan and Korea, which are very much dependent on US. India, it makes a lot of sense for India to align with US, because China is already a big enemy on multiple fronts, not only as a neighbor, which is hostile, but also from a trade perspective, because India competes with China, if in the regional and world level. And we have seen exactly the same things play out right now. And we are seeing that all those, the allies are coming together. Europe is split now because they are very dependent on China, and South American countries and African countries. They're all probably wondering, because they all want to align with US, but China is almost owning them now, as we saw on the first chart, which we started with. So that is one thing. And then ultimately, what Trump is trying to also do is, because of his political base, he's trying to strengthen the US industry, because that is where Republicans' old agenda is to bring the jobs back, bring the middle class and the lower working class back in US, and bring the critical manufacturing back, and so on. So, and finally, I think, as I said, because means Trump has got this mandate with the House and the Senate, both Republican for a where they can get the laws passed in for a very short period. By the way, if you don't understand U.S. politics, basically in 2 years we have midterms when there will be a potential change. So Trump has to go very fast and achieve in next 2 years. He doesn't have 4 years of his term to achieve it because he might lose the House in next 2 years. So this is why I think they're also being aggressive in reducing spending and balancing the budget. So that is the main intent here, why this trade war has been so aggressive. And that is what we are dealing with right now. Now, when you're investing in the markets, let me tell you, means we all know, means, and of course, I'm not going to go into all the to and fro of Trump, going back and so. Because that is, of course, the markets have already created a big, spike down, and this most probably what happened when Trump has got soft is means he already got his he has aligned who are the people on the table for negotiation. So what he wanted to achieve is already achieved. And main trade war is with China, which he is still going to maintain. But on the other hand, I think now going back to the trade wars itself means all the way up to, you go from the biggest one, which people talk about is the biggest tariffs, which were announced was Smoot Hawley, which really crashed the market at that time also. But mostly what we are trying to highlight here is that these blips usually are short-term issues in the market when you're investing, and specifically these also are actually an opportunity. Like we can talk about COVID being one of the biggest issue, which also created a dip. But before that, we even in the Trump's first term, we had steel and aluminum tariff. We had the similar, not at the scale which he is doing now, but there were tariff escalations, and market had reacted negatively. In short, I think nothing is going to change, and we can discuss more if people have questions. But basic idea here is that these are just the opportunities in the market. And as means again, I'm a big believer in macro. Now, global macro is still the same. And let's again go back to the basic economics. The basic economics is money supply determines the asset prices. Because the assets are the same, the companies and the technology development cannot be changed by these policies. But what is happening with trade war is not only China. Now, this is a very interesting chart, and I think everybody, if you're an investor at a global level, global money supply determining the asset price is the biggest truth in the whole investing world, and we have followed it, and we have always found success with this. Now, what is happening here? I think what matters is let's look at US chart. So US, as you know, has been in a money printing environment since 2008 crisis, and only this continued till I think we hit the post-COVID crisis when we actually accelerated. So this kind of a crazy money printing happened after COVID, and then since 2022 we have been on the quantitative tightening. And as you know, recently, Fed has removed most of the quantitative tightening, and now they are actually increasing the money supply again. So US has gone through that cycle, which we saw in 2022. We had market corrections. We had almost all assets correcting in 2022, and that is going up. By the way, US is the biggest money supply in the world. So if you look at the numbers, which are not very visible here, this is really huge numbers. And the second biggest, or actually, China is even bigger because they are a bigger population and bigger money supplies internally. China has been, since COVID, has only been printing. They have never ever slowed down. The reason being, they have gone through a real estate crash. They have gone through a slowdown of exports because of COVID lockdowns. Their internal consumption has slowed down. Their population is shrinking. So China is in a very heavy, stressful situation for last 4 to 5 years, and they have been maintaining their economy only because of the stimulus. And this is the money printing you can see. They have been in the same level of money printing which US was till 2022. Now, Japan has been also growing their money supply. Euro usually follows US, and since the trade war, they have accelerated and this is mainly because of Germany, because of the defense spending needed to balance out Trump's pulling out of the Ukraine and so on. So all these things, again, I think we can discuss and we can spend a lot of time on this, but let me tell you, is ultimately what is the moral of the story here is that global macro is suggesting that the asset prices have to go up yes, there is fear in the market right now. Yes, there will be hiccups on individual stock level, and stock market will react in short term. But ultimately, this is 5 to 6 year trend, which I have captured here in this chart. If you map M2 money supply of the world and the asset prices, whether it is gold going up, whether it is stock market going up, um, relative allocation only can change, because if you have money supply increasing, where will it stay? It has to be invested in the assets. You cannot have the money supply expanding and asset prices have to attract in relative allocation. And it's the only matter of fact is that whether you allocate into a certain market versus other, that defines day-to-day movement. And as we already established, the US is probably the only place where you can, where the size of the market, liquidity of market, and the technology evolution is happening. It makes perfect sense that US markets will continue going upwards once this short-term use plays out. So this is the last slide on the US macro. And I would hold here for questions from people if they have any. And Kiran, I would let you know, means we can jump into a little more of Proflex strategies and in how we work and what is our background, if that is of interest. Of how we invest would be a other topic which I wanted to present.
Yeah, perfect. Before I think we deep dive into your strategies, right, Raman? So I would just like to ask one question from my end. I think that we have a couple of questions that are coming through as well. So you're saying like US will be the hegemony, right? I think that they've been spending in R&D, leader in AI, robots, whatnot, and a bunch of stuff. Now, all the folks who have joined here are investors, they're all family offices primarily. So just help us, how should, someone sitting in India, all these macros are super good, but from the investing perspective, if they have to invest and start creating wealth for themselves, how should they navigate it? What are the, should they look into public markets? Should they look into private markets? If so, how? How they should get access to the US market is primarily,
Sure. So I think let me first take the part between private and public. So just to give you a background, of course, I build strategies for public markets. Usually we invest into stocks and heavily use options for, how we hedge our investments and also accelerate the returns. I have also got a 10 plus years of experience in the venture capital world. I mean, being in Silicon Valley means this is where we learn a lot. And me and my partner now in Proflex, who is actually a veteran in startup world with $500 million of exits of his own, which is so it's a pretty interesting question when you say whether one should look into investing into startups or public markets. My view is that means I am moving more and more towards, and we are suggesting our investment in US more and more towards public market for two reasons. One is that the public markets are becoming very robust, and the opportunities in the space is immense with how the public markets are evolving. As we have seen the rise of NVDA's, rise of Tesla, rise of we have already seen 10x to 20x returns, which are very difficult to get in venture world because the success ratio is very low in startup world, where you have to take, we used to always say that if you invest in 20 companies, if one, you are only hoping for one of them in venture world to give you all the returns, and 19 usually hardly give you any cash. But what we are seeing is the success ratio is further coming down for two reasons. Now let's talk about the private equity investments. What happened in last 10 to 12 years since 2008 crisis up to 2020 and even beyond, up to 2022, let's say 14 years, we saw the biggest evolution of startup coming out. You can talk about Ubers of the world, you can talk about all these we call it unicorns. And the reason being that we fundamentally changed. We said money is free because we were talking about almost 0% interest rate capital available in Silicon Valley. So the 14 years of that created huge unicorns, which went IPO, and they were great exits. But that created a culture of, where we don't work in the same efficient manner. We on most of these startups now, if you look at the AI world, you will not see any startup raising a $250,000, which used to be a norm when I started in venture world in 2010 or so, we used to give out a 250K check. Now we are talking about, the first raise itself is $5 million, $10 million. So first of all, the risk taken is huge, and the success ratio is reducing, and there is no risk reward in private market anymore. And second thing is, when you had 0% risk-free rate or 1% risk-free rate versus a 4 or 5%, we are now living in probably a much longer high interest rate environment. And the actual return needed in private equity to make money they are actually not even investing into those aggressive ideas. Now they are investing into safe ideas where they have and those kind of returns usually don't come. So you are basically not doing the venture style investing. You are taking safer approach by not taking risks on high growth ideas. You are going with a more safer idea. And second thing is, you are actually putting in so much money that you will hardly generate those 20% annualized return, which I think S&P 500 has been giving in last few years. So this is where I think we are suggesting our investors to focus on public markets for two reasons. One is that even if you look at like NVIDIA, Google, and all of these players, they are themselves VCs. Like if you look at NVIDIA itself, it's almost, they have the best view of the world of AI because they are providing the computing power for that. And NVIDIA itself is buying some of the best companies, and they are investing themselves into some of the best ideas. They own almost, they invest into each of the startups. So why even consider investing into a venture fund when it means all these companies are becoming so big that they themselves are huge venture funds in themselves. And one more thing I can give you an example is Waymo. Now, Waymo is a startup within Google, and it is probably going to be spinned out at some point. Now you are getting the benefit directly by owning Google share. You don't have to go and look at investing it through a venture fund. So that's what my call would be. That world has changed quite a lot in the venture world, and it's probably better risk reward to consider public markets. And most importantly, you get liquidity, right? Means venture funds in US have become even more and more difficult to exit. And they are the time period has been extended from 5 to 7 years. So now we talk about 10 to 12 years minimum. And even if you look at the recent times with all the free money available, their IRRs are dropping every year if you look at the exits of venture funds. So I think we have started focusing more on public money now, public markets now. I hope that was what you were intending to ask.
Yeah, perfect. I think we have a couple of questions coming. So I'll let you complete the strategies and your thesis, and we'll jump onto the questions. Go ahead.
Sure. I think a couple of other things I want to talk about, because the audience is mostly looking at USD allocation from INR perspective. So I'm sure everybody knows, but I had a very quick notes on, like, we all know that INR keeps depreciating. So I'm not going to spend too much time in this. And main reason being India is being a very heavily import focused market, and we are seeing that there's no significant change across multiple years. That as we see imports, exports increase, imports are also increasing. So that was just one more comment which I think I had missed out. Now let me quickly cover on Proflex, just a little bit of background. So how we operate is, as we already discussed, macro view. We are very big on starting from a macro view. So beyond what I talked about, I have been working with at least 100 analysts. We subscribe to the research. We are basically the consumer of research in some of the best research in US. So we do get very heavy research feed every day. And we, being in Silicon Valley, we have done a lot of analysis around how to filter this research. We call it as a verification across multiple sources. And we first of all filter the database research, and we build our macro views. Specifically on technology world, because we are we ourselves are experienced in working inside technology companies, myself, my partner, and so on. We have been, I'm personally advising multiple AI startups and previously blockchain startups. So we also have feet on the ground, ears on the ground, as you can call it. And we do very heavy filtering out of the trends. So that's been one of the major success criteria, is finding the right trends. And then we have built expertise in last 20 years over derivatives. How do you manage your investment? One thing is, I know that I keep hearing these headlines from that India is one of the heaviest options trading market. And means I started, by the way, when I started in IIT Bombay, options market was just launched in 2001. I remember I was 2000 actually, year 2000. I had my first stipend and I put it into, because I did not know how to buy stocks because the money was too small. Like I had only 2,000 rupees. I thought, okay, options is the only thing I can buy. So that was how I started into options, and I think that's what led me to this whole kind of rabbit hole. But anyway, coming back to the point that we use heavily derivatives, we use derivatives for risk management, we call it. We are not speculating, which is, I think, the unfortunately has become the biggest use of options. But we believe is that options are there to give you protection, and we call it as an insurance market. And what we realize is that, as we always say in the US, that insurance companies never loses. If a market gives you losses, yeah, insurance company can raise the premium. So same thing works in options, and we have been using that very successfully. And then finally, I think the biggest thing which we have done is being, again, the Silicon Valley benefit we get is our experiences in iterate and verify. So as we say, we used to have this whole philosophy in the startup world where we say that if you launch a product, you get a verification. You don't believe in what you believe in, and you should be ready to listen to customer. We applied the same philosophy here, where we said that you have to listen to the market. You cannot build your macro view, and if market is not agreeing with it, you should quickly iterate and verify. And based on this, I think we have created a formula which has been working for us. And as we say, we start with a macro view. We use heavily derivatives to build hedged entries into the market, and then we are willing to change and adjust. That is our philosophy. And I think let me, before we jump into the other things, but these are some of the successful, I think, where we have generated really high returns in public markets. And we have identified trends. Means I'm mostly put in the recent ones because that I think people will relate to it. We do have, of course, a long list of how we have identified trends, and I can discuss a little bit. Like gold was something which we have been identifying using geopolitical trends. And last year we had, issued this talk about how it will be one of the biggest up move from below $2,000, and now we are sitting at 3,500. NVDA we had done very early on at I would say sub $25 mark after split adjustment. Tesla we had done pretty early on last year when it was at the lows of 140. We found this trend and we were at we caught it and we generated almost 300% returns on that. Then we had we are big on Bitcoin market since 2017. I have raised crypto money and so on. Previously, we have managed my family office money to deploy into crypto also. And most importantly, in 2022, we had picked up the huge bet on Grayscale Bitcoin, which is the GBTC, which was actually 50% discount to Bitcoin, while Bitcoin itself was $25,000 at that time. This was tradable in public markets for people who did not want to buy crypto. It was listed on exchanges, and we were able to generate almost 500 to 600% returns on this in very short time. Then we had now going back in history, I would say when I remember then Meta, or which used to be called Facebook FB ticker. We had invested in it in 2012 at $20, and we had reduced our break-even point using derivatives to $5. And that we exited after, I think this was one of the biggest success at that time. Within 2 years, we had done almost 1,000% return, that is 10x the money. So these are the kind of things we are able to achieve using macro trends. And again, as I was saying, means mostly it is we have this proprietary philosophy of amped advantage, we call it. It is mostly using volatility to your advantage. That is our model. And idea here is that you are able to use derivatives like when the market is more volatile. And I think, Kiran, you highlighted, and we were discussing privately earlier, how April 9th was one of the most successful day for us in some of our portfolios were aggressive. Means we generated some amazing triple-digit return in a single day because of the craziness. Means we had 20% moves on top stocks like NVIDIA, Tesla, and so on, which really because of the volatility advantage we have, we were able to generate very, very significantly high return in a single day. Again, this is because we love that the idea that even though you have a macro trend, that market is always going to be volatile. And more volatility, usually using our proprietary technology, we are able to get much higher returns. But again, we don't speculate, we only use them to create those additional returns. Again, we can dig deeper and set up meetings if people are interested in specific strategies of ours. So I would stop here on this and take the questions, because I think we are also may have limited time. And this is just a quick note on our team. So I think we already talked about myself a little bit. I have my partner, who is my friend, who has been working very closely with me for a long time, not in a professional capacity, but he has now been full time on Proflex. And he's also, and I think with the kind of experience he brings in, I think we are now able to scale up to a lot more kind of products. And more importantly, I think for India, we are working with Dovetail India, which is which is managing almost $1 billion worth of assets now, and they offer both inbound and outbound. And we have been able to create a tax means we have a lot of US investors who invest in India through this vehicle, and we are also now enabling Indian investors to come into US. So I think this was one other question I think, Kiran, you had earlier, how Indians can invest into US. I would say, consider, if you're a family office, if you're a high net worth individual, consider coming into a tax efficient route rather than investing directly. And we are able to create that using this team which we have with Dovetail, where we are able to create a tax pass-through kind of structures into investing in and out of India.
Perfect, awesome. I think someone had a question before we take questions in the chat box. If you have any questions, feel free to unmute yourself and ask a question. Okay.
So I can then take the
Then I think we can take
question.
questions from the chat box. So I think Santosh is asking two questions. One is, I know Trump is actually doing this tariff play to gain competitive advantage against China, but like how are the US companies reacting, and what is the macro stuff that is happening on the ground? So
Sure.
tariff is one part of the deal, but building that competitive advantage is the most important part. How is that shaping up, and what is the sentiment on the ground?
Yeah, I would say it's not very different from what you can call, means if I'm following India from outside, but I'm sure most of the people know it, like we call it Make in India campaign from BJP since 2014. I would say it's very similar. So let's also understand it's very similar. World is getting divided into left and right. Trump comes from Republican Party, which is right, which is all about be self-dependent. It's very similar. If you look at slogans of Trump, they are very similar actually. Atmanirbhar and self-reliant and all the exactly same words he's using. So let's put it this way. Okay, on the ground, what is going to happen? Of course, nobody's going to make toys. Nobody's going to make small goods in US, because even if they make it, nobody's going to buy them because they will be 4 times more expensive than what they get from China. So I think what is the things to be achieved are the defense critical things. For example, definitely there's going to be a push to get semiconductor here. So TSMC is already investing into fabs, and Trump is going to make sure that happens. They may push, NVDA has already committed $500 billion investment into building their whole, not only the silicon, which TSMC is building, but also the whole the whole system, Blackwell system, which is going into the AI infrastructure. So all the critical stuff. Now, car manufacturing may come in a little bit more because, and it's less about strategic, it's more about the vote bank of Trump. Like we call it Rust Belt. The Rust Belt is a big voter of Republicans. And as you may know, Detroit used to be the biggest car hub, and it got destroyed in this globalization as the more and more Japanese cars and Korean cars were bought. So I think they have their own political agenda somewhat for certain industries. And strategically, I think from defense perspective, electronics, semiconductor will be the focus. And yes, there will be a lot more, this India style narrative of, buy Indian, make in India. But again, I'm sitting from outside, and I'm going to say that we all know that there is a problem here, right? Means I don't think India has become, even after 10 years of effort, has India become the manufacturing hub? No. Means we are still struggling to compete with China. So the same thing is going to happen with the US. Means it's not just, means people misunderstand China as a cheap labor place. It's not. They have become the expert in manufacturing. The world has helped, and US itself has helped China become that. Now you cannot take that back from them because they are the manufacturing hub. So the only thing, and as you know, right, means China is a lot of Chinese goods are already going to be sent to Vietnam, and they will be made in Vietnam stamped, and Vietnam will make a deal with US. So that is my view. Like a lot of things will be that, but the biggest opportunity exists for India probably because if India can become like it can show competitiveness. I'm sure countries like Vietnam, countries like and I'm sure Mexico and Canada is going to benefit a lot because we still have this North American treaty. But again, to answer your question, no, nothing is big is going to change. The only thing here is to balance. I think China is already struggling because their own consumption is going down, their population is going down. So US is just trying to break down the dominance of China. So as long as they can reduce China's growth rate by not growing at 5-6%, growing at 3-4%, they will be happy. And mostly the critical parts like semiconductor electronics will come to US for sure. They will keep pushing for it, but even that probably will be just part of it. It will not be fully moving to US.
Okay.
Because again, that is my view on this.
Awesome. So Preeti is asking, so who could be the global leader? Who could take their position in the next 2 to 5 years? And will there be any sharp turn in terms of rebalancing,
I mean, again, it's difficult to look into the future, but 2 to 5 years, nothing changes. As we know, like I'm an observer of macro trends. Let's also be very clear that nothing changes so fast. Means there are reasons for things to exist, right? Means there are reasons why China is successful because of their culture, because of means whether we agree or not. Means I know it's a controversial thing, but democracies don't develop better. Democracies are tough to manage, and China has been able to do it because they are not a democracy. So we have to understand that. The work culture and all those things matter, and US is not going to change, or India is not going to change and become a huge manufacturing hub very fast. But I would say these are called tailwinds, right? Means what Trump is creating is tailwinds, and this is giving opportunity. Now, if there will be definitely, like if you see already, even before Trump came in, Tesla makes 100% of the car here in US. This is the only company which is actually not only a Mag 7 company, $1 trillion company, and they are into hardware, right? They are making actual cars. And they have been doing it for the reason it is very efficient for Musk. Like he's a control freak. And he said, I want to have every manufacturing here because I don't like communicating with Chinese. So there are people who are able to achieve these things. And I can go into detail because we have followed Tesla like anything since the start. We have a big investor in that. But I'm trying to highlight here is that there is opportunity, which one thing is ease of manufacturing in China, which like somebody like Apple has done, that they have put all their manufacturing in iPhone, and now they are forced to come into India. So this is what we call a tailwind for somebody like India to get more manufacturing into India. That is because these companies have the DNA of I want easy, I want cheaper. And then there is opportunity he's creating with this trade war. Trump is creating that other countries, if you have the, you can build the DNA of manufacturing, please take it. And now, yes, I think Vietnam is already leading in that. I think India has the opportunity, and there are a lot of other countries which are going to step up. And it's a matter of who will come in. I don't know. Means I think I would like it to be India because I think India has the potential, the population, the intent. But I would say that it's very tough to change the DNA of the whole system. So we would love to see how this evolve. But it definitely the intent here is to break down China, and that pressure will be on till Trump is there. And who comes in is very difficult to replace now, China. I mean, I think they will still be just bypassing their goods through Vietnam or other places like, and they will still be making the things.
So that brings us to our last question here. So you briefly mentioned about India could benefit out of it. I think recently, 2 days ago, Google Pixel was actually discussing on bringing some of their manufacturing back to India. And I think they were holding talks with Dixon and Foxconn, and all of a sudden, there was super rally in both of, especially in the Dixon stock. So the question was around in this whole tariff saga, where can India benefit, and what are some of the sectors that you are bullish on where India can actually capture this opportunity?
Yeah, so I think, means again, we have recently started last 6 months, and I would say, Kiran, you are probably watching India more closely. Means from a US perspective, let me put it this way. India would probably benefit. You should look into places where they have the competitiveness. Like, for example, are there any companies which are doing great in precision engineering? Are they competitive at a world level? Definitely, it's a big boost to, I think, something like textiles, something like, pharma can benefit a lot because of the kind of, push from generic medicine in US, because Republicans are a big believer now of, why there is so much price gouging by big brands. So, and India is the leader in generic pharma manufacturing. But on the other hand, I would say it all depends on how relative deals are achieved. Like, Indian government has a big task ahead of it, like, whether they can get better deal than, for example, in textile, if they get a better tariff structure than somebody like Bangladesh or, Vietnam and all that. Can they get a better tariff structure? Because India has the biggest opportunity for India is in how they will navigate this size, that we are the next biggest. While we can dilute China, we are not threatening yet as India. So that is the story of Indian government negotiation, right? Means that whatever China was 20 years ago, is US willing to make India, that place where US helps and then become the adversary in 20 years? That's probably, if I have to, guess, means that may happen if India takes, it from China, because all the ingredients are in place. In fact, when we are talking about investing in India from US investors, and as we are raising money here, we are telling the same story, that India is exactly at the place and the opportunity is there. Now, whether India takes it or not, we don't know, but definitely it's a great tailwind for India right now.
I think we're at a great inflection point. It's just that the North and South bloc has to work really in tandem and go very aggressive on that. I think just breaking the rule and taking one more question, since you briefly mentioned that you have keenly followed Tesla and are a very big investor in that. There's another question on, I think there was a lot of talk about BYD catching up recently, right? So what is your opinion on BYD vis-a-vis Tesla?
I think BYD is a great company in the sense that they have built great products. But on the other hand, remember one thing, that in a bipolar world, BYD will never be able to sell cars in US. BYD will never be able to get those deals, and they will always be seen as a Chinese company, which is, which has to be tariffed or which has to be controlled. So it's and secondly, I think when you look at, again, I will go back to where are Chinese companies in full self-driving or robotaxis versus where Tesla is. Even I think there are a lot of videos in, how even in Chinese conditions, Tesla is doing better than Chinese owned robotaxis. Those kind of comparisons are coming. So I think it's a technology matters. Means definitely BYD has taken the scale. As I think it's very similar to what you say, iPhone versus a Huawei phone in China. So you can compare Tesla and BYD in the same way. Like, Huawei sells way more phones than iPhones, but who makes most money is iPhones. Like, Apple makes more money. Huawei and Oppo, all these Chinese companies sell more phones. So the same thing is going to happen with BYD and Tesla in long run, in our view, that BYD will probably be the biggest car company. But whether they will be the best technology company or best for investors and making more money, that is not proven yet.
Perfect. Awesome. I think just right on time. So thank you so much, Raman, and thanks everyone for joining us on a Friday morning. So what we will do is, we'll share the recording over the weekend, and also we'll reach out to you guys if you wanted to learn further about Raman's strategies, what they have been building, and we will be more than happy to set up follow-up calls from there on. On that note, Raman, any final note, and we can close the session.
No, I think thanks, Kiran, and I think it's great to talk to more people. And I keep coming to India like every 6 months, because still, like, I want to connect back with India. This is why we started the India Fund. Also, we brought our strategies to Indian markets. I would love to meet up and connect with everybody. That's all I can say in the end. And thanks for listening.
We will do an in-person session on India in Mumbai or Bangalore sometime. Okay, cool. Thanks everyone for joining. Have a good weekend. Take care. Cheers.
Thank you for that.